When an asset's price is rapidly climbing, the pressure to jump in builds with every passing second. You see a clear, explosive uptrend, and the fear of missing out on easy profits becomes overwhelming. But right behind that urge to buy is a paralyzing fear. You know that if you buy right now, at the absolute peak of the rally, you risk entering the exact moment the market decides to reverse. Blindly chasing a high price violates the single most basic rule of trading: buy low, sell high. Give in to that pressure, and you end up trapped in a losing position, holding an expensive asset while the value plummets. The solution is patience. You have to wait for a temporary price drop. You need a discount deep enough to offer a cheap entry point, but not so aggressive that it destroys the overall upward momentum. Professional traders don't guess where this optimal entry point is. They measure it using a mathematical sequence called the Fibonacci Retracement. While it sounds highly technical, the Fibonacci tool actually has very little to do with abstract math. It is a precise, visual map of mass human psychology during a market trend. Look at this chart with the default Fibonacci tool applied. At first glance, it is an intimidating, chaotic mess of grid lines, colors, and decimal numbers overlapping the price action. The first thing you must do is delete the background and strip away all the noisy data points. Most of these lines offer no value. We isolate and highlight only 3 specific decimal levels: 0.382, 0.5, and 0.618. Clearing this visual clutter stops analysis paralysis. By removing the excess data, you force yourself to focus exclusively on the specific price zones where a bounce is highly probable. To deploy the tool, you need 2 physical anchor points on your chart. The first is the swing low, the exact bottom where the upward push began. The second is the swing high, the absolute peak of that push. On this graph, we simply draw a line to connect the swing low up to the swing high. The moment we do, the tool overlays our 3 key horizontal levels across the chart. The empty space between our peak and these new horizontal lines is our active retracement zone. This is the exact window where we expect the price to drop. By drawing this structural boundary, a random, anxiety-inducing price drop becomes a predictable, measurable event. You now have a defined area to watch. Here is a chart showing a simple scenario. An asset surges from a baseline of $100 up to a peak of $200. Now watch the price line correct back down to $150. It perfectly aligns with our 0.5 Fibonacci level. The asset has just corrected exactly 50% of its recent upward surge. At this exact level, human psychology takes over. Traders who sat on the sidelines and missed that initial surge to $200 now view this 50% drop as a massive sale, and they start buying aggressively. They are joined by the early investors. The people who bought at 100 and cashed out their profits at 200 see that the asset is cheap again, and they reinvest. If the price drops even lower to the 0.618 level, an area often called the golden ratio, the asset is running at a nearly 60% discount. This provides the maximum psychological incentive for buyers to flood the market all at once. These mathematical levels work because they map the threshold of human greed. They pinpoint the exact dollar amounts where the collective desire for a bargain outweighs the fear of further decline. There is a fatal flaw to relying solely on these numbers. A steep discount is completely meaningless if the wider market has permanently turned against the asset. If you blindly buy an asset on this chart just because it touches the 0.618 line, you can easily get wiped out when the price ignores the math and plummets violently straight through your level. This leads to the golden rule of the strategy. You never execute a trade purely because the price touched a Fibonacci line. These levels are not invisible trampolines guaranteed to bounce the price upward. They only indicate where on the chart you should look for a trade, not when to pull the trigger. To know exactly when to buy, you must wait for a behavioral confirmation trigger on the chart. You need to see a bullish signal, like a hammer pattern, forming directly on top of your Fibonacci level before you enter the market. This entire logic works in reverse, too. During a downtrend, you measure from the high to the low and wait for bearish confirmation signals to sell short when the price bounces upward into your retracement zone. But remember, this framework requires a clear direction. If the market is moving sideways with no distinct highs or lows, the Fibonacci tool will fail completely. By combining the strict structural measurement of a retracement with the behavioral proof of a candlestick signal, you stop guessing. You decode the psychology of the market to consistently identify the safest, most profitable entry points available.